Markets moved violently today as investors reassessed a key assumption about growth, policy, and risk. Under the surface, today's price action demolished the diplomatic hope narrative that briefly energized markets, replaced by the grim realization that the energy crisis has mutated from a disruption into active destruction. U.S. markets suffered a severe, broad-based liquidation event today. The selling was indiscriminate across market capitalization, with the Dow leading the breakdown, closely followed by the S&P 500. The Nasdaq dropped nearly 2% as higher interest rates violently compressed growth stock valuations. The defining characteristic of today's action was a violent rotation out of pure growth and into energy and selective defensive sectors as systemic risks mutated. In the commodities complex, we witnessed a super spike. Crude oil exploded over 8%, shattering through $112 per barrel on verified reports of physical infrastructure destruction. Simultaneously, gold surged over 3%, re-establishing its safe haven status and confirming its return as the favored hedge against stagflation. Conversely, the deep cyclical sectors were slaughtered, led by consumer discretionary and financials, as the market priced in both demand destruction and re-emerging systemic banking risk. The catalyst for this violent shift was the collision between mutated geopolitical risk and an unraveling economic baseline. First, the conflict has transitioned from a maritime blockade to active kinetic attacks on fixed production infrastructure. Geopolitical risk has mutated from temporary disruption to prolonged production decline. Verified missile and drone attacks on two major upstream production facilities in Saudi Arabia have shut down a significant percentage of national output. The market had been pricing the reopening of a shipping choke point. It is now pricing the rebuilding of destroyed critical infrastructure. Restoring these flows is a process measured in months, not days. This repriced a much deeper, longer-lasting global energy shortage. Simultaneously, we warned about this. Regional banking stress is re-emerging as the dominant constraint on the Federal Reserve. Newly released data on regional bank capital reserves show a sharper-than-expected deterioration in the first quarter. Analysts are pointing to the confluence of mounting commercial real estate losses and the inability of these banks to sell their underwater bond portfolios at current yields. This violently revives the 2023 banking crisis narrative and actively constrains the Fed's ability to fight energy-driven inflation.
Today's flows suggest an emergency liquidity consolidation and hedging complex by institutions. This wasn't a tactical rotation, it was a broad-based capitulation. Offensive positioning was abandoned. We saw a definitive duration exit in technology and consumer discretionary. Capital is fleeing growth as investors confirm demand destruction is real, reinforced by airline comments on fuel surcharge impact. Defensive positioning, however, was selective. While tactical hedges like energy stocks continued to attract capital, acting as the only expression of the atoms over bits trade, significant flows returned to traditional defensives like staples and utilities as safe harbor plays. Institutions are selling cyclicals that rallied on ceasefire hopes if they lack conviction in a swift diplomatic resolution. Financials, meanwhile, were the worst performing sector, dragging the Dow and S&P lower as contagion fears intensified after the regional bank stress reports. This reveals a fundamental pivot. Psychology has shifted from Hormuz truce relief to securing capital insularity before a perceived systemic crack. One open question investors are debating right now is whether this pattern of production facility attacks, mutating the risk from blockade to permanent destruction, is already fully priced in or still underestimated by the broader market. I'd be curious how you're interpreting that move in the comments. Is 112 oil just the beginning or the tactical top? The primary hidden risk is the secondary energy supply cliff. Everyone is repricing a shipping freeze, but the real risk is that the physical production facilities in the UAE and Saudi Arabia are still running out of storage. The storage facilities in the major regional ports, like Jebel Ali, are reportedly at maximum capacity. If the strait remains difficult for commercial transit for another 72 hours, regional wells will be forced into shut-ins or physical shutdowns. Unlike a shipping freeze, a well shut-in can take weeks to reverse, even after diplomatic breakthroughs. The market is ignoring the geological reality of physical shutdowns. This suggests the market stability may be more dependent on the storage capacity of regional port facilities than it appears. Today reflects a medium-term regime shift, a change in expectations. We have moved past inflation concern and into systemic disruption. The divergence of oil up and gold down seen recently was the hallmark of a liquidity crisis. Investors were selling gold because they must cover margin calls in their bond and equity portfolios, not because they lack fear. Today, however, gold surged with oil, a massive regime shift signaling that safe haven demand is finally overcoming that forced selling dynamic. This signals a potential shift in how markets interpret central bank policy. The Fed has officially abandoned its stability mandate. Inflation is now the only priority, even if it forces a systemic credit crack. The entire macro narrative is holding its breath for the next 48 hours. The primary narrative shifter will be the regional port production reports. Any news of mandatory well shut-ins in Saudi or the UAE due to lack of storage forces a catastrophic global trade repricing towards the $120 plus oil. The primary confidence breaker will be the Q1 bank capital stress reports on March 27th. Any surprise weakness in regional bank capital reserves will violently revive the 2023 banking crisis narrative. The next phase of market direction may depend on whether the global diplomatic machine can keep the energy narrative from snapping back to total shutdown. What this suggests for investors is that yesterday's rally was tactical damage control, not a regime shift. The Fed's stability put provided relief, but the Hormuz truth expiration guarantees that $100 oil will continue to compress consumer margins. Maintain elevated cash levels, hold physical assets, gold and materials as stagflation hedges, and prioritize insularity, defensive growth, over broad market exposure. The Fed's stability put has expired, but the physical reality of a $100 oil regime remains the dominant constraint on earnings growth. I'd be interested to hear how you interpret today's signals, especially the rotation out of offensive growth. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.